Good morning, welcome to the Killik & Co market update. So a week in the UK wouldn't really be a week in the UK if we didn't spend some time at least talking about Brexit. The good news, I suppose, is the first time in 3 years we have a bit of a path forward. The government was able to pass its withdrawal agreement bill through the House of Commons on Monday, and it passed the bill passed in its second reading. Now, the withdrawal agreement bill, or the WAB as it's become affectionately known, is effectively the framework that allows us to leave the EU in an orderly fashion on the 31st of October. The second reading of any bill is the first opportunity that MPs actually get to vote on the contents of that bill. Beyond that initial success, the government failed to pass its programme motion, and the programme motion is the timetable effectively to fast-track Brexit-related legislation through the House in order to allow us to leave on the 31st of October. So because of that failure, Boris Johnson was obligated under the Benn Act to write to the EU and request an extension, which he has done so begrudgingly, and the EU has now accepted. So comments over the last few days have been generally supportive from the EU about giving us an extension, although there has been some kind of noise from France, I guess, suggesting that they may be keen to explore a shorter technical extension down to a couple of weeks to kind of push us along, I guess. So the EU leaders do meet today to discuss this. We might hear something over the coming days, hopefully. There's a further twist yesterday afternoon when news broke that Boris Johnson's now actually going to look to pursue a general election on the 12th of December. So Labour are not currently supportive of a general election, and it's unclear how the EU may actually use this or factor this into any decisions they make about the time frame around the extension they may be willing to give us. So as it stands, Brexit legislation is paused pending further news flow from the EU about the length of that extension. But it does feel like we're getting somewhat closer, even though the situation is very, very fluid still, and the news flow certainly will continue unabated for the next over the coming days and weeks, that's for sure. So Rachel mentioned last week that Brexit-related news has been causing some UK equities to stir, and I wanted to pick up on some of that this week and just briefly illustrate what that positivity looks like. So what I've actually done is I've created our own index, or a mini basket, if you like, of UK house builders who'd be relatively sensitive to Brexit-related news flow. So it's a market cap weighted index. So what I mean by that is that the bigger companies by value have more weight in that underlying index. So what I've done is I've pitched that against the FTSE 100 and the FTSE 250. So within the FTSE 250, we have some more domestically focused companies which would prove more sensitive to Brexit-related developments, certainly more so than the FTSE 100, which derives more than 70% of its revenues from overseas. And I know we've mentioned here before, but a stronger pound will act as a headwind to overseas earners unless they do take some steps to neutralise that currency risk via some form of hedging programme. So it's actually interesting to note that due to some of the bigger companies in the FTSE 250, the index as a whole still actually does derive 50% of its earnings from overseas, or its revenues rather, from overseas. But looking at the chart, we can clearly see how positive Brexit-related news flow kicked in on the 10th of October, and has since seen our index of house builders and the FTSE 250 outperform the FTSE 100. But there's an important point to note here. Firstly, when we look at the size of the spikes in our index compared to the other two, this has highlighted some of the volatility that we're seeing in some of the more Brexit-sensitive stocks. But also look towards the end of this chart, and you can clearly see how the less positive Brexit sentiment, so that news flow around general election, for example, on Thursday afternoon, is affecting these companies also. So we've seen a bigger move to the downside than the broader indices. So there's definitely some stirring around Brexit-related beneficiaries, if you like, but depending on the news flow, it could still be a bumpy ride. So we're in the midst of US earnings season at the moment, and a number of companies have reported numbers since last week's update. So I'm not going to go heavily into individual company reports, but I thought I would just highlight how US earnings season is shaping up so far. So at a glance, we've seen 192 out of 498 companies report so far in the S&P 500, which is the US broad-weighted index. 146 of those companies have disclosed positive sales growth, and 142 have reported positive earnings growth. growth. So pretty much 75% of companies who've reported have seen growth of some sort, which is clearly a good thing. And of those 192 companies, 65% of those disclosed sales numbers which were ahead of market expectations, so beating what people were expecting, and 80% of companies released earnings that were ahead of expectations. So clearly not shaping up to be a bad earnings season so far. And I've actually just highlighted some of the companies that were reporting this week, just so you can kind of see where they've beat, what's beat and what's missed. Looking to the week ahead, clearly there's a number of companies reporting again this week, peak earnings season in the US, but we'll be looking out for the likes of Alphabet, BP, Ecolab, CME Group and Lloyds, just to mention a few. That's all for this week, and if you are following the Rugby World Cup, do enjoy tomorrow's match, and we'll see you again next week, hopefully with an England win.